Greetings and thank you for joining us today. Your time investment in this video will surely pay dividends. Today we're going to delve into the fascinating world of bonds. We'll talk about what they are, how they're priced, and the difference between corporate and government bonds. We'll also discuss how interest rates can impact bonds, and demystify terms like year-to-date, yield-to-call, and coupon payments. So buckle up and stay with us as we embark on this journey to decode and demystify the world of bonds. So, what exactly are bonds? You might have heard this term thrown around in financial circles, and it's one of the keystones of investment. But what does it really mean? Let's break it down. A bond, in its simplest form, is a loan. It's not much different from the loan you might take out to buy a house or a car. But in this case, you're the one lending the money, not borrowing it. You're the bank, and the borrower could be a corporation, a municipality, or even a government. Imagine you have $1,000 that you're not using right now. You could stash it under your mattress, but it's not going to grow there. So you decide to lend it to a reputable company who needs capital to expand their business. They promise to pay you back in full, with interest, in 10 years' time. That's a bond. You've just become a bondholder. But why would you want to become a bondholder? Well, it's a way to make your money work for you. The borrower, whether it's a corporation or a government, agrees to pay you interest on your loan, typically twice a year. This is known as the coupon payment. And here's the beautiful part. Even if the borrower's business venture fails, they are still obligated to pay you back. That's because a bond is a contractual obligation. It's legally binding, which makes it a relatively secure investment. Now, it's important to understand that bonds are not without risks. The borrower could default on their loan, which means they can't pay you back. But generally, the risk is lower compared to other investment tools like stocks. So, in essence, when you buy a bond, you are lending your money with the expectation of a return. It's a way to grow your wealth over time, and it plays a pivotal role in a well-diversified investment portfolio. But, like all investments, it's important to do your research and understand what you're getting into. After all, it's your hard-earned money on the line. Now let's delve deeper into the types of bonds. Corporate and government bonds. At the heart of the bond market, we find two main players: corporations and governments. Both issue bonds to raise money, but the similarities mostly end there. Corporate bonds are issued by companies. When you buy a corporate bond, you're essentially lending money to a company. In return, the company promises to pay you back with interest at a predetermined date, known as the bond's maturity date. However, corporate bonds generally come with a higher risk compared to government bonds. That's because companies are more likely to default or fail to repay the loan. But with higher risk comes the potential for higher returns. Corporate bonds typically offer higher interest rates to attract investors and compensate them for this additional risk. On the other hand, we have government bonds, issued by national governments. In the United States, for example, these are known as treasury bonds. When you buy a government bond, you're lending money to the government. Government bonds are considered extremely safe investments because it's highly unlikely a government will default on its debt. This security, however, comes with a trade-off. Government bonds typically offer lower returns compared to corporate bonds. So which one should you choose? Well, it all depends on your risk tolerance and investment goals. If you're a conservative investor looking for a safe place to park your money, government bonds might be your go-to. But if you're willing to take on a bit more risk for the chance of higher returns, corporate bonds could be worth considering. As always, it's crucial to diversify your portfolio. You might consider a mix of both corporate and government bonds to balance risk and potential returns. And remember, investing in bonds is about more than just picking the one with the highest yield. It's about understanding the risks involved and making informed decisions. As you can see, choosing between corporate and government bonds depends on your risk tolerance and investment goals. But how do we price these bonds, and what role do interest rates play? To understand this, let's take a trip to the financial market. Here, bonds are priced based on the present value of their future cash flows. These cash flows include the periodic interest payments, also known as coupon payments, and the payment of the bond's face value at the end of its term, the maturity date. Now you might be wondering, how do we determine the present value of these future cash flows? Well, that's where interest rates come into play. The interest rate is used to discount these future cash flows to their present value. The higher the interest rate, the lower the present value of the future cash flows, and thus the lower the price of the bond. This brings us to the concept of the inverse relationship between bond prices and interest rates. Yes, you heard that right. Bond prices and interest rates move in opposite directions. Think of it as a seesaw. When one end goes up, the other comes down. Here's why this happens. When interest rates rise, newer bonds come into the market offering higher coupon rates that provide more interest income to the bondholders. As a result, the demand for existing bonds with lower coupon rates decreases. This decrease in demand leads to a drop in the prices of these existing bonds. On the flip side, when interest rates fall, new bonds offer lower coupon rates. This makes the existing bonds with higher coupon rates more attractive, leading to an increase in their demand and hence, their prices. So, if you're holding bonds and anticipating interest rate changes, consider this seesaw effect. If you think rates will rise, understand that the price of your bond may fall, and if you believe rates will decrease, your bond's price might just go up. Remember, when interest rates rise, bond prices fall, and vice versa. Keep this mantra in mind and you'll navigate the bond market like a pro. Scene script, let's now turn our attention to some key terms in the bond world: YTD, YTC, and coupon payments. First up, we have YTD, or year-to-date. This refers to the period starting from the first day of the current calendar year up to the present day. In the realm of finance, YTD is used to analyze trends or performance data within that specified timeframe. When it comes to bonds, YTD return is a measure of the total return of the bond since the start of the year. This can be calculated by subtracting the starting price from the current price, then dividing the result by the starting price, and finally multiplying the result by 100 to get a percentage. Next, let's talk about YTC, or yield to call. Basically, this is the total return a bondholder would receive if the bond were to be held until its call date. A call date is a feature in some bonds that allows the issuer to redeem the bond before its maturity date. The yield to call considers the interest or dividends received through the call date, plus any capital gain or loss. It's a bit more complex to calculate than YTD, but it's a crucial concept for bondholders, as it helps to evaluate the potential return of callable bonds. Lastly, we have coupon payments. This term harks back to the days when bondholders would literally clip off coupons from their physical bond certificates to redeem their interest payments. Today, the term simply refers to the annual interest payment made by the bond issuer to the bondholder. It's calculated by multiplying the bond's face value by its coupon rate. Understanding these terms and calculations is crucial in making informed investment decisions. Remember, knowledge is power, especially when it comes to navigating the world of bonds. The more you understand the terminology and the math behind these investment vehicles, the better equipped you'll be to make decisions that align with your financial goals. We've covered a lot of ground today, and we hope you're now more comfortable with the concept of bonds. We've journeyed through the basics of what bonds are, explored the nuances between corporate and government bonds, and delved into how these bonds are priced. We've also navigated the choppy waters of interest rates and their impact on bonds. Our expedition didn't stop there as we decoded key terms like year-to-date, yield-to-call, and coupon payments. We strive to demystify these terms and illustrate how they're calculated and utilized in the world of bonds. But while we've shed some light on the topic, it's crucial to remember that this video is intended for entertainment and educational purposes only. Investing is a personal journey, and each one of us has unique financial goals and risk tolerance. Therefore, it's essential to do your own research before diving into the bond market or any other investment. Seek professional advice if needed, and always ensure you're making informed decisions. Our aim here is to spark curiosity, to encourage you to delve deeper, and to provide a starting point for your financial education journey. We hope we've managed to do just that. Thank you for joining us today. If you found this video helpful, please click the like button and subscribe to our channel for more insightful content. Remember, your financial journey is just beginning. Stay curious, stay informed,